We study billionaires, and this is episode 85 of the Investors Podcast.
Broadcasting from Bel Air, Maryland, this is the Investors Podcast. They'll read the books and summarize the lessons. They'll test the waters and tell you when it's cold. They'll give you actionable investing strategies. Your host, Preston Pish and Stig Broderson.
Hey, how's everybody doing out there? This is Preston Pish, and I'm your host for the Investors Podcast. And as usual, I'm accompanied by my co-host, Stig Broderson, out in Denmark. And I'll tell you what, we're going to have some people really excited about today's show because our guest today is the one and only Jack Schwager from the famous compilation of books titled The Market Wizard Series. Here's a little bit on Jack, and I know that people listening to the show already know who you are. A lot of people listening to the show already know who you are, but if they don't, I'm just going to give a quick background so people know who you are, Jack. Jack got his degree in economics from Brooklyn College and also a master's in economics from Brown University. He's probably one of the most accomplished financial writers in the world, and he's interviewed countless billionaires and prodigies within the financial community. When you read one of Jack's books for the first time, you'll quickly realize that the person who's asking the questions in the book, which is Jack, is at par and just as smart as the person who's answering the questions. So Jack's the author of Market Wizards, The New Market Wizards, Stock Market Wizards, Hedge Fund Market Wizards, The Little Book of Market Wizards, The Complete Guide to Futures Markets, and Market Sense and Nonsense. So these books are not like 100-page books. All those books that I just listed, they're not like these short little 50-page or 150-page kind of books. In some cases, Jack's interviewed up to 20 different people that are total prodigies within finance. Like Ray Dalio, we talk about Ray all the time on our show. Jack's actually sat down and had an interview with billionaire Ray Dalio. So that's just one of the hundreds of people that he's sat down and actually interviewed. So with all of that, Jack, I want to jump to the questions because the last thing I want to do is be the guy talking the whole time. We want to push the talking over to you so you can just share your knowledge with our community because this is really exciting to have you on our show. So thank you for joining us.
Oh, thanks for that intro. Appreciate it.
So my question up front, knowing the caliber of people that you've sat down with, Jim Rogers, I mean, there's some people that you've interviewed that I'm big fans of. What was the one investor that you've interviewed that you were most impressed with? And what would be that one key takeaway that you had from that person's approach that you still keep with you today? What would be that one person and that one thing that you took away from all these interviews?
You know, it's like asking who's the greatest baseball player ever. You know, it's impossible to answer, really. I mean, totally. So I'm just going to not talk about these people now because we'll probably get into some of them later. But just to throw out what I mean by that, you take somebody like Ed Thorp, who had one of the best track records ever. I mean, so extraordinary that in one book I calculated the probability of getting that track record as being less than the amount of atoms in the entire mass of the Earth. Now you take somebody with that, and by the way, his record in terms of return risk makes Dalio look like he doesn't know what he's doing. Obviously, yeah. But on the other case, Ray Dalio has made more money for investors than any other hedge fund or any other fund. Well, I don't know the mutual fund world, but any hedge fund that has ever existed, I think Dalio has made more money for the investors, as far as I know. Then you have somebody like Michael Marcus, who I know because I worked at the same firm that he did, that turned a $30,000 account into $80 million in the course of about a dozen years. You've got somebody like John Bender, who was a brilliant options trader who made literally hundreds of percent a year, physics background. I can go on and on and on. So how do you say who? And I haven't even mentioned people like Kovner, incredible investors ever. And somebody like Druckenmiller, like a 40-year track record with near 30% returns compounded. So how do you pick the best one? It's just not, or the most impressive one. In terms of pure intellect and accomplishment, if you put a gun to my head, it might be Thorp and Ed Thorp. Now, for your audience would probably know Ed Thorp best, not from his money management side, but they would know him because he wrote this famous book. Actually, his book sold more books than I did, Beat the Dealer. So that was not his only book, but that Beat the Dealer was the first book to tell people how to win a blackjack. But
that's the one that they built the whole movie around, where they went to Vegas and they were counting cards.
Yeah, so actually, because it's even more incredible than that. I'm just going to give you a few of the things here. Here's a guy, starts out, comes from a very poor background, grew up depression, teaches himself physics in high school, gets accepted, I forget to which California, one of the top universities in California. He doesn't have his PhD yet in physics. He was writing his thesis for his physics degree, decides he doesn't know enough math, goes and starts taking graduate math courses, gets his PhD in math, never actually goes back and writes his thesis, so he doesn't technically have the PhD in physics. Then gets the idea that he'd like to beat casinos. It sounds completely preposterous. How can you beat, not by cheating, by the way. And so the first scheme he comes up with is roulette. Now, when I first heard the concept that, hey, somebody says they could beat roulette, I said, it's impossible because we're thinking probability.
Yep.
But you don't think in terms of Newtonian physics that what he literally thought about was, well, if you could time it well enough, you could get by the physics. If you got this velocity of the ball between two different points and you knew its momentum and everything else, you could predict a probability of which octet of this wheel was more likely. This is back in the 60s. So we didn't have back in the 60s, I remember the 60s, even the late 60s, I remember using an IBM 360, which took up a better part of a room, and you had to use punch cards and to do, regressions or something like that. So, and he in the 60s developed this miniature computer way ahead of his time. And so this thing worked. They played for minimal amounts of money. They just wanted to prove the concept. They had a 40% edge in roulette. Then he came up with then he read a paper by some math guys in, I forget where, that was saying win at blackjack from a mathematical standpoint. But what he came in with the insight was that, hey, it's not a matter of how you just bet, because that's what these guys were trying to do. They were saying, if you bet all the right ways, if you hold on 16, take the card, the typical standard rules. If you did all the right bets, that actually turns out you still don't have the edge. You come very close. But he thought, he got the brilliant insight, wait a minute, who says you have to bet the same thing every time? So he kind of figured out that if you change the size of the bet, like when the more cards out, then you bet more picture cards out, you bet less, less, you bet more, that could totally change your probabilities. And he was doing this and realized it would take him years and years or actually more years, maybe decades to do. So he had to find shortcuts, but he figured it all out and came up with a couple of methods actually, and then simplified. And I put a story in a book where there was an attempt on his life. I just out of the movies, his car was fixed, sort of, his brakes wouldn't work going down a hill. But in any case, so he did that, put out the book. That was the book that changed the casinos. The multiple decks, all of that, that's because of him.
Oh, yeah. So, Jack, would you say that the thing that you took away from Edward Thorp was just his pure intellect? Yeah,
that was the thing that impressed me, was just the intellect, just a raw intellect. He was a really nice guy, too, I got to tell you. I met a lot of brilliant people, but, Thorp is probably the smartest guy I ever spoke to. And I've known people that made me feel stupid. But he did. When I say made me feel stupid, I don't mean that he made me feel stupid. It's just in comparison to his intellect. I just feel, we're just not.
Is he like a voracious reader that got him there, or is he just?
It's just raw intellect. I just think he's got that talent, and that's how he beat the markets. He started to apply this intellect, this pure quant intellect, to markets, and then you go on. First guy to start a market neutral fund. All these strategies, he's the first guy that does it and figures out how to do it and gets the edge. So not only brilliant, but innovative, thinking outside the box. He was the first guy to think of it. So he's an amazing guy. And people don't really know him to the extent they know some of the other big names. They know him for the Beat the Dealer book because it changed casinos and all that, but they don't know his hedge fund.
Yeah, and correct me if I'm wrong, Jack, I think he came up with a pricing model for warrants long before Scholes get all the fame for the options theory. Thank
you for reminding me. Yeah, maybe the biggest thing is everybody knows the Black-Scholes model. Nobel Prize was given for the Black-Scholes model. The amazing thing is Thorp's trading a mathematical equivalent of the Black-Scholes model 5 years before that article was ever published. He could have been the Nobel Prize winner, right? But that's not, he said. He was the only guy in the world who knew how to price options, and he was just printing money. So he was, for that, until that article came out, he was just, he had like a printing press of money because he just couldn't lose. He knew how to price options nobody else did.
He's like, I've already been doing that. I've been making millions of dollars doing that.
Yeah. That's part of the record. That part of his record is because he came up with all these things ahead of everybody else. That's how you get a record of something like, I think it was about 277, I forget the exact number, months. 3 losing months out of 277. And all 3 of those were less than 1%. And that's why I say, the probability, that's why the probability works out to be less than less than picking one atom randomly out of the mass of the Earth.
Wow. I'm so happy, Jack, that you mentioned it, Thorp. I haven't told this story on the podcast, and this will be for another time, but he's actually the reason why I'm standing here today. So I'm so happy that you actually you mentioned.
Oh, well, you should say, go on. I mean, I'll talk enough on this, but I'm curious about how that happened.
Yeah, I mean, it's just very, very briefly. I read some of his material early on and was just very fascinated about his way of looking at everything as a game. I think perhaps that's really his true gift. And perhaps that was also why he didn't, necessarily win the Nobel Prize. I mean, that was not the game he was playing and how he was looking at casinos, and then afterwards how he was looking at stocks and how he was pricing options. And I think I started reading that around the age of, I want to say 20 or something. And that was really what made me make the decision to go into all this that we're doing now, even though it's just a long time ago. So I feel I owe him a lot. And it's just rare that we have a chance to really talk about him and how influential he's really been on so many people and in so many different ways. For me, he's one of the most underrated out there in his own field, which is basically just really, really sad. Perhaps because he didn't want the fame, who knows?
Yeah, he's kind of not he tends to be on the quiet. He doesn't seek publicity for sure, on the contrary.
We were completely shifting gears here, Jack. So one thing that I know that we completely agree upon is how important it is to have independence in your strategy, whether it is investing or trading. And you have this quote from the famous trader Michael Marcus saying, you have to follow your own light. So still we can get swayed by other people that we consider really smart, even if these people might follow another strategy. So I would like to ask you, could you please tell your personal story about not shorting the yen back when you were director of futures market?
This was after I'd done the first book. And it was, I'm not going to mention a name here deliberately, but one of the traders I interviewed would call me from time to time. And he would call me and ask my technical opinion on the markets. And I never knew why, because he was like a million times better trader than I was. Why he would want my opinion, I don't know. But he would do that, and we'd talk. So one day he calls, and we're going through the markets, and it had to put this in context. Okay, this was a year I started off. I made money. I was ahead. Then dribbling of money. I was losing. I'd given back most of the money I'd made. I was still ahead, but not by very much. I decided to sort of cut back. I had like one position left of any consequence. Maybe I had something else, but just really one. And he gets to that market. It's a Japanese yen. Got to picture this, what the chart looks like. It had a very sharp decline, like a falling off the cliff. And then it went into a very, very tiny consolidation, really, really thin. And he gets to the yen. I said, well, when I've seen a pattern like this, where the market's down extremely steeply and then goes into a tiny consolidation, most of the time it'll go down again. And he says, well, no, Jack, he gives me 58 reasons why. I said, hey, well, you're probably right. It's just an opinion, So anyways, I hang up the phone, and I knew, like I said, I should not listen to other people. I knew that. And I normally wouldn't. I really think I wouldn't have. However, this is where fate intercedes. That afternoon, I had to travel for a few days to go to Washington, D.C. I knew I had a lot of meetings. I'd be busy. I didn't. This was pre iPhone, obviously pre the smartphones and all that. And I wasn't going to even have a computer of any sort to look at anything. So I said to myself, well, I haven't been doing so well lately. I've got this one trade for good profit. Here's one of the smartest guys, one of the best traders I know, who's on the opposite side of this trade. Do I really want to fade him on the trade? So I go over to the overnight desk and I get out of the position. Okay, I come back a couple of days later. I don't know where the market is. I'm not following the market. Come back a couple of days later. You and your listeners will probably know the next thing. Sure, the yen's down a few hundred points, right? Okay, so that's no surprise. We know that's going to happen. Now, here's where the surprise is. And this is, I tell people, honestly, I'm not making this up. I couldn't make this up. That day he calls again. I wasn't going to be so gauchious to bring up the end, and it's like, hey, everybody could be wrong. I'm not going to say anything, but he brings it up. And I say, hey, are you still long? And he exclaims to me, long? He says, I'm short. Now, what I didn't tell you is, for me, I traded positions, particularly at the time, for like months at a time. For him, a long-term trade was like 2 days. When he was speaking to me, he was bullish because he was looking for a bounce. The market probably didn't bounce. He probably decided it wasn't acting right, or maybe went down a little bit, got out, went the other way. So he made money, and I was right all along, ended up not making anything. So it's like a perfect example. You can't listen to anybody. It's going to mess you up. And going back to Marcus, that great quote, you have to follow your own light. Mm-hmm. The rest of that quote, paraphrasing, is you could take the best traders in the world, two of the best traders in the world, and put them together, and you'll get the worst of each. And incidentally, I know he was speaking about Michael Marcus hired Bruce Kovner, who then went on to form Caxton, one of the great legends of trading and investing. He had hired a Kovner, and for a time they traded from the same office, so they talked, whatever. So when he says that, he's talking about himself and Kovner. So literally two of the world's best traders, and he's still saying that if they don't stay true to their own approach, they're still going to get messed up if they try to trade like the other guy does.
I've got a kind of a follow-up question that really hits at the point you're getting at, and that's matching your style or your personality with your investing approach, and it has to do with Joel Greenblatt. So I know that you are close with Joel. I know he's endorsed some of your books. You've interviewed him a couple times, and Joel has some books out there that really kind of take Warren Buffett's approach and make it a lot simpler, and he calls it his magic formula. And after interviewing him, do you think that people out there could simply pick up his two books and really kind of implement this magic formula and get the fantastic results that he's had? And please tell our audience Joel Greenblatt's results, because he has really high returns to the years. And what kind of personality do you see that really kind of gets attracted to the Joel Greenblatt approach?
I've heard of Greenblatt, and then I've dug up the track record, and it ended at I did the book in 2012. His track record ended in 1995. That's a while ago. Now, it was a very interesting track record. It was about 10 years long. It had all winning years, of course. The worst year he had was like a profit of about 28%. That was his low year. And that was and remember, in that period, you had 87 crash, you had 94, which is a bear market. And his worst year was a positive 28, 29%. So, and then with the NAV at an all-time high, the fund disappears. My first question to Greenblatt was, why did you close the fund? I mean, who closes a fund in 10 years where the worst year is plus 28%? He said that he had just gotten too big, that he couldn't do the trades managing other people's money, because he was doing a lot of sort of value-oriented trades, which might have been involved some smaller cap stocks. They couldn't do them.
Like he was doing nets on small cap. Is that
some accurate? Stuff like that. He was doing a lot of different strategies, but it's the Buffett philosophy of buying of a value orientation. And so that's what that is at his heart. He's so told, that's in his bones. And in fact, I'll get to your question in a moment about whether people can use the formula. Let me just give you this aside, because part of what I do for the interview, I try to do different things to get to know people in the interview process. It's not just like I sit down with them for 1 hour or whatever. But in Greenblatt's case, I met him a couple of times, but I also he was teaching a course at Columbia. He was teaching a course on the markets on the graduate school level in Columbia. And so I sat in on one of the courses. For this particular session, he had said, well, okay, today I'm going to be Buffett, that you guys ask me questions, you ask me questions and I'll answer them. And so the class was asking questions, he's answering them, and they were getting completely confused. They said, well, wait a minute, are you answering this as Buffett or are you answering this as Professor Greenblatt? They couldn't tell. I couldn't tell either. It sort of went back and forth between the two. So basically, this whole question of, and let me give you this other thing, which will answer your question indirectly, but in a more interesting way, as whether people can use the formula. So he did this study using this magic formula, or more advanced form of it or whatever. And then he'd rank the stocks going forward based upon a formula. And it turns out that the top decile, over a longer period of time, the top decile, did the best. The second decile did the second best. The third decile, and the lowest decile did the worst and lost a little bit of money. So my first question, being a kind of an analytical guy and value investing, the first question that sort of pops up into my mind, which is so obvious, is, hey, why buy the top decile? Why don't you buy the top decile and sell the lowest decile simultaneously? You'll have a balanced portfolio, presumably much less risk, and actually more return because the lowest decile actually lost a little bit of money. So to me, it seemed like, hey, that's such an obvious thing. How come you didn't do that? So he says, yeah, that's a good question. That's also a question a number of my students asked. And he said, there's only one reason that I didn't do that. He said, I would have gotten wiped out if I did that. And the reason he explained was, good example, late 1990s. Late 1990s, stocks are going crazy. Everybody thinks, well, tremendous bull market, S&P's up 20, 30%, NASDAQ's going through the roof, the internet craze, stocks are going from 10 to 200. Okay, everybody knows all that stuff, right? You forget that really the value stocks, a lot of value stocks weren't only going up, they might have been losing money, right? So you've got an atmosphere here where the worst garbage is going on its way from 10 to 200 before it goes back to 1 or 0, right? But you've got that interim period where it's going to 200. So you get a period where the really crummy stocks are going up tremendously and the good stocks are losing. What does that mean? That means if you've got 100%, you've actually lost more than 100% of your money. And he literally would have gotten wiped out doing that. So while in most years that strategy looks like much better return to risk, in that situation you get killed.
So it's interesting. We had a guest. Do you know Wesley Gray? He's a hardcore quant guy, really awesome. We got to introduce you to Wes because he's just a wealth of information. He runs around with Patrick O'Shaughnessy and James O'Shaughnessy in that group. But one of the things that he did was a lot of research on what you're talking about exactly, where when you get into a really high market valuation period, kind of like where we're at right now, growth picks do extremely well and maybe not what you would necessarily think, but then they just fall off a knife's edge whenever the value picks really start doing well when the market starts having a major downturn. So it's really interesting that you kind of got the same feedback and the same information from Joel Greenblatt when you were talking. I really find that interesting. And we've talked
true.
And we've talked about this on our show when we had Wes on. It's a really interesting discussion. I know Wesley Gray has a lot of published articles on it. Maybe we can throw some of those into the show notes to kind of complement this discussion. But awesome feedback. Thank you for that, Jack. That was awesome.
Yeah, well, and also, so what Greenblatt says, and this is it's cute but true. So he has his three rules of value investing. The first rule is value investing works. The second rule is value investing doesn't work all the time. And rule number 3 is rule number 2 is while rule number 1 works. If anything worked all the time, enough people would use it, would stop working. And it's because you get a 99 that value investing still works. Because if it was just a matter of buying undervalued stocks and staying with them, then everybody would do it and it would just, but it would stop, the edge would go away. But so anyway, that's his explanation. So the answer to the magic formula is it'll work most years, but there'll be times where it doesn't work. And it could be for a long time.
So Jack, one thing that's really interesting about Joe Greenblatt is that he's thinking as a trader, but also as an investor. So many investors, they think in terms of buying a stock, hopefully it would be undervalued, and then the price will eventually go up. Now, traders, they also think in terms of leveraging their own position, not necessarily using debt, but if they have a really strong opinion about where a stock is going, they might be able to get a higher payoff. One of those ways to do that is using an option. And I know that you have a very interesting story about your good friend Joe Greenblatt and how he used options to invest in Wells Fargo back in the early 1990s.
Yeah, so to set that up, I should say, because people have a misconception about options being more risk and so forth. They can be more risky. The way most people use them, they are probably more risky. But the idea here is, and the way some great investors have used them that I've spoken to, again, Greenblatt's one of them. This is one of the ways he got such a great track record. And somebody like in the hedge fund market was like J.D. Mays, a guy who really trades like that all the time. The math of the option market is that it assumes there's always an equal chance of a market going up or stock going up or stock going down. And these traders realize, or investors realize, that there are points in time where that's not necessarily true. the natural pricing of an option to be symmetrical in terms of percentage gain and percentage loss is not going to be correct. And so in this case, with Wells Fargo, he realized, Wells Fargo is a very, very solid stock. It was a very, very strong company. However, at the time they had, their book contained a lot of real estate in California, and California was the real estate market was having real problems. So there was concern about the bank. But Greenblatt thought that they'd be fine. But he said, basically, there's two possibilities. If this is really going to be a problem, they're going to go bust, then it's going to be a zero. And if, like, I think it's going to be okay, then the stock is like tremendously underpriced. It should triple, quadruple, whatever. So his play was, and of course, he didn't want to just buy the stock and leave himself, take that bet, hold it till it goes to zero, take a chance of that. What he did instead was buy out of the money options. And his thinking was, but out of a money option, you're basically not going to get paid unless the market goes up, or in this case, the stock goes up significantly. However, it's relatively cheap. You put up a small amount of money. In this case, if the stock goes down, goes sideways, or only goes up moderately, he loses that amount. But it's a small percentage of the total cost of the stock. However, if it gets to the strike price, and let alone if it goes well beyond the strike price, then you start getting multiples of your money. And so to him, it seemed like a really good play because the market was saying, hey, there's like a 50-50 shot of Wells Fargo going broke versus, being okay, where in his mind, it was much better than a 50-50 shot they'd be okay. And he played it in a way that if he was right, he'd get paid multiples of what he was risking. So that was the basic concept of the trade. The end of that story is, I don't know, went up like 4 times or whatever.
400% return.
Yep.
So, Jack, one of the things that I really liked about your book is some of the people that you've interviewed through the years really kind of have just crazy or like really interesting approaches to making money, and they're successful at it. That's the thing that's just so mind-blowing for me. Like, one example that comes to mind was the guy from your hedge fund book, the Hedge Fund Market Wizards book, where he was breaking all the phones and just kind of seemed like he had this wild and rampant personality. And then another one was the gentleman that your son worked for, who was actually betting in the exact opposite direction of whatever the market was trending, and yet he was still able to make money. So I guess my question is what was one of the more interesting investing approaches that you've come across with all these different interviews? What would you say that you took away from interviewing that person that maybe you could actually apply to your own approach?
Boy, so it's a really bifurcated question, because the latter part of that is like, what did I take away and what I learned, that type of stuff. And there's lots of answers to that. And has a positive answer. Then you began with a couple of people. And the second one you mentioned, the one that my son worked for, Jimmy Baladimas. If you go through books, one of the things you note is, or most people realize is, hey, all these guys are doing something different. It's like they're just nothing like each other. It's not like a bunch of guys doing the same thing. So you got people all over the map. However, if your question had been, who was the most different trader, style-wise, who used the most different approach versus everybody else, it would be Jimmy Baladimas, because here's a guy who's using an approach that it just flies in the face of everybody. It's just counter to everybody's advice. It's counter to what everybody does. It's something like, if you told me somebody does what Baladimas does, I said, this guy's going to blow up in a year or two. And he's been doing it for, 20 years, whatever he's been doing it for. First of all, what does he do? So what Jimmy Baladimas does is he has this personality where he has to be opposite everybody. He can't stand to be, he always has to be fighting everybody. He has to be on the opposite side of everybody. And the more people are crazy about something, the more he wants to be on the opposite side of it. So you get markets where extreme markets like, and he trades both stocks and commodities, but to talk about some of the commodity examples, because they're the really extreme ones. If your audience might remember silver, I don't know how, 4 or 5 years, 6 years ago, I forget exactly what year it was, but where silver was really going straight up, and it went all the way up into the 40s and eventually got to low 50s. Well, and it's going almost vertical. Who's selling silver? Well, there's Jimmy selling silver right into that uptrend at 45, 46, And, you had cotton market, the cotton market that had, since the Civil War, had never gone to $1, goes to like more than above $2. And it does the last part in just a very short period of time, just like another cliff. And who's selling cotton when it's like $2? That's Baladimas. So he steps in front of freight trades. And not only that, it'd be one thing if he did that and then just held the position when the markets eventually crashed. But then on the first good break, he takes his profits. It's like insane. But no, he has to find something else to fight. So that's the style he does. And the reason why, and by the way, I say in that book, the first line of that chapter is Jimmy Baldemus breaks all the rules. And the first line of my conclusion to that chapter is, or first line or second line is something along the line is, don't try this at home. Nobody trade this way. I don't want anybody to trade this way. How do I know he's for real? Because like I say, my son worked for him. And so he arranged the interview and all that. So what I knew from my son worked in the firm, and everybody knew that Jimmy was like this guy who produces $multi-million results almost every year. First day I go to interview him, set the scene. This is like the end of the first quarter. I forget which year it was, but it was like 2011, I think. But it was one of those years where the stock market was going up almost every day. And the first quarter had been up pretty steadily. And that March, the month I went to visit him, it was one of those days the market couldn't go more than 3 or 4 days without making a new high. So if you were like short, I mean, you couldn't grasp, you couldn't catch your breath. It was just like down a day, up again, and so at the end of the month, very end of the month, last day of the month, I think it was, the market's down 2%. And there was some story about, I think, Libya or something. And there was some excuse for the market to go down and sold off. And so I go into his office and he's got the monitors. My son's there too. And all the screens are like all red. Everything's like all red. Because that was the day the market was down, right? And it turned, sure enough, of course, he's been short everything, right? So, but it's one day the market's down. And first of all, he's there. Couldn't tell us like you figure a guy's been short, a market's going straight up. Finally a day, the market's down 2%, everything, the whole screen's red, he's short. You think the guy would be like, I wouldn't know if he won or lost that day. If I came on a day he was losing, he'd be the same way. He's just like, that's the way it was. How's the guy short a market that goes up every day, virtually not every day, but it's going up almost every day of the month, gets one day where it's down and still ends up breaking even? How do you do that? So the thing is, and this is where he makes the money. This is where his skill is. And this is something you can't teach. But he's always taking profits. He's always taking money off the table. So he's short a stock, and it's a terrible trade. The stock's going to go from 50 to 100, but he's short. So he goes short. Let's say he's short at 50. The stock opens up 49.5. He sells some of it, goes up 51. He buys it back, and then goes up to 51. He'll sell it again. So he's constantly taking these small little profits along the way. And so even though he's wrong in the trend, he's making these profits on these because he's just capturing money off the table continuously. And he does doing about 500 trades a day, according to my son. So that's how he was making his money. But he could have made a lot more money if he did the same thing with the trend. But he insisted on doing it against the trend. So
to me, it just seems like that you would eventually blow up with using that approach. But you're saying he's still been doing it
for a long time. And I can't tell you how. I would have been the first one to say the same thing, Preston. I would have been the first one. And I would have said, it's impossible. Nobody could trade this way. And maybe he won't get away with it forever. But it's been a long, long time where he's been doing it then. So, yeah, I don't think anybody should. I really mean it. Don't trade that way. Every 9,999 people out of 10,000 will go broke doing this. And the last one out of 1,000 will lose 80% of their money. So nobody trades.
This wraps up our first part interview with Jack Schwager. Stay tuned for the next episode where we continue the discussion with Jack and learn more about fundamentals in trading and how to measure your performance in investing.
Thanks for listening to The Investors Podcast. To listen to more shows or access to the tools discussed on the show, be sure to visit www.theinvestorspodcast.com. Submit your questions or request a guest appearance to the Investors Podcast by going to www.asktheinvestors.com. If your question is answered during the show, you will receive a free autographed copy of the Warren Buffett Accounting Book. This podcast is for entertainment purposes only. This material is copyrighted by the TIP Network and must have written approval before commercial application.